Hey guys, welcome back to Be Rich. It's me, Sashwath, here today to record another video on this channel. Both my uncles are still busy, and I figured that I'd take this opportunity to come to this channel and talk about something that's important for every investor to know. And this is a topic we've talked about many times. And today I thought we could take a possibly different perspective on it from one of the seminal books on investing, which we always talk about, The Intelligent Investor. And if any of you at home have a copy, I would urge you to open it up, go to page 401 in the commentary of chapter 15, and follow along as I dissect what is written here, because the topic for today is how the enterprising investor or an active investor who picks individual stocks is meant to invest in the Warren Buffett way. So, without further ado, let's read what is there in the book at first and then let's break it down. So, it says Warren's way. Graham's greatest student, Warren Buffett, has become the world's most successful investor by putting new twists on Graham's ideas. Buffett and his partner, Charles Munger, have combined Graham's margin of safety and detachment from the market with their own innovative emphasis on future growth. So, a lot of you say that value investing doesn't factor in growth, or value investing is almost ignorant of future potential and what the good things one might expect from a company in the future. But value investing is not. Value investing in the Warren Buffett and Charlie Munger way is a perspective or method where you're also factoring those things in. Let's see how they do it. So he says that he looks for what he calls franchise companies with strong consumer brands, easily understandable business, robust financial health, and near monopolies in their market, like H&R Block, Gillette, and the Washington Post Company. Buffett likes to snap up a stock when a scandal, big loss, or other bad news passes over it like a storm cloud, as when he bought Coca Cola soon after its disastrous rollout of New Coke and the market crash of 1987. So, when a good company or when a great company, which is marked by having a very recognizable and strong consumer brand, which is known as a moat, and near monopolies in their market, which means that there are barriers to entry. Barriers to entry meaning that it's difficult for a new guy to come in, enter the market, and try to, let's say, capture a share of the market. And he also says robust financial health. So things like how much free cash flow is the company making? Is there How much debt is there? Is the company more reliant on debt, or is the company more reliant on retained earnings in order to be able to grow? So when you have these factors, and then finally he also says that he gives us a few examples. He gives us Gillette and the Washington Post Company. The Washington Post Company is a bit dated as an example, but Gillette, of course, it's as a man I need to shave, and when I need to shave, I do use Gillette products. And like as the slogan goes, Gillette, the best a man can get, right? So the idea is that Gillette has all these characteristics. It has a strong consumer brand, it has a near monopoly in its market, and it has robust financial health, and it's a very understandable business. That is, it's within your circle of competence. Almost everyone knows what the business model of a shaving foam manufacturing company is, or a razor manufacturing company is. You source the raw materials, whatever it may be, steel, all the chemicals required for manufacturing the Gillette shaving foam, and then you have the tin can which you have to put the shaving foam in. You package all this in a neat and, let's say, tidy fashion. You stick on a label, and let's say you have a marketing team to come up with a slogan like Gillette, the best a man can get, and you pass it off to the consumers through distributors. This is the business model. It's not that hard to understand, and with a few hours of study, one would be able to be quite fluent with the business model. So, given this, and given Coca Cola, which is another company which has a very easily understandable business model, these make for good examples. And he also says that you don't buy them when everything is fine. For example, today, if you wanted to buy, let's say, Hindustan Unilever or Nestle, because we talked about that yesterday, if you want to buy those companies in India, especially, the premium that you're going to pay is going to be huge. There's nothing wrong with the company. Things are going fine. Maybe there's a little bit of stress from the, let's say, the bottom 10% of India which consumes such products, or the bottom 20-30%, which is the lower income product lines which these companies have in terms of the soap or the detergent, all these factors. But even then, I still think that these companies are doing just fine, and the PE ratios they're commanding are also quite high. Nestle India is commanding a PE ratio of 72, and it has a dividend yield of 1.44%. It's trading today at 2,232 rupees. Hindustan Unilever is another such company which is commanding a PE of 54. So, my point is, unless something goes awry or something breaks the investors' expectations in these stocks, it does not make much sense buying them at these price ranges, because, like Asian Paints, these companies, if you enter at the wrong time, you're not going to make a lot of money in. And you can look at the chart and you can see for yourself that there have been many periods where the company has been quite overvalued, and if you had bought it at that point, there wouldn't have been much in the terms of gains you would have made from these companies. So, given that Coca-Cola was bought by Warren Buffett in 1987, and then there's another point which it talks about. It also says he also wants to see managers who set and meet realistic goals, build their businesses from within rather than through acquisition, allocate capital wisely, and do not pay themselves $100 million jackpots of stock options. Okay, so when you talk about stock options, it basically means that the ability to buy stocks of a certain company at a certain price, or even sell them, could be either way, either one, but generally it means buy. So the point here that Warren Buffett is trying to make is that the manager should be working for the benefit of the company rather than for the benefit of himself, and he should be compensated fairly and not luxuriously. Given this, we also know that Warren Buffett is saying it is better for a company, or rather, he wants a company to expand internally rather than acquiring businesses as a way of growth. So, what this basically tells us is that the company needs to be strong, and the underlying business model needs to have the capacity to fuel growth in the company's earnings from within rather than having to stretch out. And also, finally, Buffett insists that there needs to be steady and consistent earnings growth in the company so that the company is more valuable tomorrow than it is today. So, when earnings are growing, that naturally means that the P ratio will shrink. This is where a lot of the valuation strategies come in, because all of us are trying to figure out at what rate it's going to grow, and at what PE will it be in the future, and at what rate will it continue to grow in the future. So, the person who's able to accurately pinpoint these numbers is the person who's going to make the most on his returns. However, us being investors and us being fallible, that is, we don't have a perfect opinion or a perfect reading of these things, we can try to make a guesstimate. A guesstimate is basically an estimate that is also a guess. So when you make a guesstimate for such a number, you come within a ballpark. As John Maynard Keynes said, it is better to be roughly correct rather than to be precisely wrong. So you want to be somewhere within the range of possibilities where you account for that margin of safety which we talk about, which will give you that ability that if you made a wrong guess, and let's say the stock is actually on the lower end of what you have guessed, you still have a margin of safety where you'll be able to get out of it unscathed. The first rule of investing, as Warren Buffett said, is don't lose your principal or don't lose your capital. Because if you lose this capital, then going forward, it's going to be even more difficult for you to be able to get to where you were and then go above that and beyond to where you need to be. For example, if you had 100 rupees and you lost a 50 rupees on it, even a 50% gain on your 50 rupees is still not going to get you back to 100. Those of you at home can do this calculation and see that a 50% loss means that you need to make a 100% gain. So if you make a 50% loss on, let's say, 100 rupees, that means you have 50 rupees left. For you to even get back to 100 rupees, you have to double your money. And we all know how hard it is to double your money in the market, especially in the short run. So, which is why you need to take care of the valuations that you're paying, and you also need to take care of the fact that you're investing in a company that is sound financially. Finally, the page also says probably no other investor, Graham included, has publicly revealed more about his approach or written such compellingly readable essays. One classic Buffett proverb: when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. So he says that no matter how brilliant your managers are and what the reputation of your managers are, the point is that if a business has a reputation of bad economics, that reputation is intact. What he means to say that a bad business cannot be turned around by a good manager. A bad business at times is inherently bad. So, which is why Warren Buffett says don't look at things like airlines, because the airline industry by nature is a very competitive one where profits are not to be had. It's of a very fickle nature, and it doesn't matter who the manager is, it's going to be very difficult to be able to turn a profit. Now, we know that in India, we have Indigo, which is trying to break the mold and do something that other airline companies have been unable to. But the point here is that the exception doesn't make the rule. We all know the story of Pan Am, we all know the story of Kingfisher. So, Warren Buffett made a mistake of getting into airlines during COVID, I think, and he had to sell. And when he sold, he broke his own rule when he bought airlines, and I think he had paid the price for it. However, when we think about these sort of rules, we have to remember Warren Buffett's proverb: don't invest in a bad business model, even if it has good managers. And if you idolize those managers, look at what makes them brilliant, and you can learn from them while not having to invest in their business model, which may not be so good. So every intelligent investor can and should learn by reading this master's own words. So this book basically tells us, or rather this page tells us, that by practice we learn more, and also it puts out a step-by-step analysis of how Warren Buffett invests and how he picks stocks. And those of you at home who are listening and reading along with me, it'll do them well to write these points down in a notebook and for them to tick off as a checklist when they're trying to invest in their next business and figure out whether the company that they've picked up meets these criteria which has been set out by Warren Buffett and Charles Munger. And with that being said, I hope this video was insightful. If you have any thoughts on what I've discussed today, I would be happy to hear it in the comments below. Given that I don't have my uncle to bounce these ideas off of, I'd be happy to learn what the comments have to say about this. Maybe share your own personal insights into this, and I would be happy to continue more of these read-alongs on The Intelligent Investor or other books which you might be interested in. Nonetheless, thanks again for watching. Do hit the like button and do subscribe to the channel if you haven't already. Share it with your friends and family members if you haven't done so. And finally, leave a comment as I said before. Thank you again for watching. Be rich. Hey guys, that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it, and we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.